Inflation is no longer the biggest wealth killer. It's something else. Take a look. According to the Fed, you don't have to worry about inflation anymore because the rate of inflation has fallen to normal levels. Although we did recently see inflation come in hotter than expected. But if you ask the average American how they feel about inflation, it's a completely different story because they're still feeling the impacts of inflation. But maybe the problem goes beyond just inflation. I'll show you. Let's assume that in 2024, this bowl of guac would cost you $3. Inflation says that in 2025, this bowl of guac might cost you $4. This is an inflation rate of 33%, and people don't like inflation because that means you got to spend more money, and a lot of companies are realizing that people don't have more money to spend, so companies got crafty. Instead of raising the prices to give you the same bowl of guac, what we've seen happen is they'll say, okay, how about we just give you less guac, and instead of charging you more money, we'll keep it at $3. Now, it looks like the inflation rate is 0, when in reality, you're just getting less stuff for the same amount of money. This is a concept called shrinkflation. It's not a new concept, but it's been stealing a lot of thunder from inflation lately. And the reason why I want to highlight this shrinkflation today is because number one, it's a hidden tax that impacts how much money you have, and number two, the impacts of shrinkflation do not show up on the inflation data very well. Now, we've seen this type of shrinkflation in pretty much every industry. You've seen it in the grocery store, we've seen this type of shrinkflation with houses, and we've seen this type of shrinkflation with toilet paper. Now look, I'm just a random guy on YouTube, but this shrinkflation could be part of the reason why many people are still feeling the impacts of inflation, while all the inflation data says you have nothing to worry about. However, for full transparency, the CPI inflation data is supposed to take into account shrinkflation, but there are two problems with this. Number one, it's hard to account for this type of shrinkflation in the CPI data, and number two, this shrinkflation number does not account for skimpflation. Who knew inflation had so many ugly cousins, right? Inflation is when the value of the dollar goes down, causing the price of things to go up. Shrinkflation is when you're getting a smaller item for the same amount of dollars. So you get a bowl of guac, you buy a bag of chips, and the bag of chips is smaller. Skimpflation is when you're getting the same bowl of guac, but now it has cheaper ingredients. Or it's when you go out and you buy the same bag of chips, and there's less chips inside. For example, Whole Foods sells a berry chantilly cake that people like, but the problem is the cost of producing that cake, the ingredients kept getting more expensive, and so Whole Foods had to make a decision. Either A, they could charge you more money to buy that cake, but that makes the inflation problem worse and people don't like that. Number two, they could sell you a smaller cake, but that's also apparent. Or option number three, which is skimpflation, they could start using cheaper ingredients in that cake. And they tested out option 3, and people didn't like it. One example is by replacing cocoa butter in chocolate with palm oil, which is a significantly cheaper option, as a way to save some money on the cost of producing goods. This is where I want you to understand how this affects you, but of course, if you want to stay up to date on the top financial news like this, Market Briefs is a free newsletter that I created where every day my team is working to break down what's happening in things like the economy, the stock market, the housing market, crypto, and the global economy into a fun, witty, and easy to read newsletter. You can read Market Briefs in less than 5 minutes every morning, and it's completely free. So if you have not joined Market Briefs yet, well, I got the link for you to join down in the description below. So now we know that inflation is when we see the prices of things go up as a byproduct of the value of the dollar going down. Shrinkflation is when you buy a smaller item for the same amount of dollars. Skimpflation is when you buy that same item with lower quality ingredients. Now, it's very easy to track inflation. It's a little bit more difficult to track shrinkflation, and it's very difficult to track skimpflation because it doesn't show up in the data very well. These could be some of the things that are now impacting the inflation numbers that don't show up in the inflation numbers. And so now when somebody has to go out and buy more groceries in order to continue feeding their families, or they have to now go to lower quality ingredients to feed their families, those numbers don't always show up in inflation. Now, I know I'm describing these three things as separate things, but in reality, they're all just a form of inflation, and that's a byproduct of the Federal Reserve Bank and the government printing and spending money they don't have, because when you keep printing and spending money, the value of the dollar goes down, which then ultimately causes the prices of things to go up. Businesses have to maintain their margins, and if their cost of doing business keeps going up, they have to get creative. Either they have to sell you their products at a higher price because they got to pass down their cost, or they have to sell you less stuff, or they have to then shift to cheaper ingredients because they cannot keep maintaining or staying in business because people can't keep affording their stuff. This is what happens when you keep printing more dollars without the wealth in order to do so. But the interesting thing about this, and the real kicker here, is that the Federal Reserve Bank is now also starting to get worried about inflation again. According to the most recent inflation numbers, inflation came in a little bit hotter than expected. Not just that, we also saw core inflation go up a little bit. At the same time, we also saw a worse than expected job market number. Why does this matter? Because the Federal Reserve Bank said essentially that the inflation fight is over. And because the inflation fight is over, they felt comfortable starting to cut interest rates. But if inflation does not continue going down, and if the job market starts to get a little bit worse, that's where it can start to pose a problem, where some people have been talking about this concept of stagflation. Stagflation is different than inflation and its cousins. Stagflation is an economic effect that is really the worst case scenario. Now, for full transparency, the Federal Reserve Bank has said that there's no need to worry about stagflation, but when you get data saying that inflation is worse than expected and the job market is worse than expected, that is a concern. So let me just explain what stagflation is. Stagflation is when you see three things happen. Number one, you see a rise in unemployment. Number two, it is when you see a rise in inflation. And number three, it is when you see a slowing economy. So to put that in context, stagflation is when the prices of things are going up while people have less jobs. The economy is getting worse and the prices of things keep rising. This is stagflation, and this is a much more difficult thing to combat. And this is what some people start to get worried about when you get data saying that the inflation numbers are coming in a little bit hotter than expected, while the job market is also getting a little bit worse than expected. And this is what a lot of people are now watching what the Federal Reserve Bank is going to do, because originally, just about a month ago, the Federal Reserve Bank kept saying, there's nothing to worry about with inflation. We're going to keep cutting interest rates throughout 2024. We're going to keep cutting interest rates in 2025, and we're going to keep cutting interest rates in 2026 because inflation is on its way down. Us cutting interest rates is not going to make the inflation problem worse. Us cutting interest rates is going to stimulate the job market. Us cutting interest rates is going to make the economy boom without causing any sort of recession and without making the inflation problem worse. Now, will that happen? Only time will tell. I'm not here to make predictions because financial predictions are kind of like armpits. Everybody has a couple and some stink more than others. This is where I want you to be a financially savvy investor. And that means I want you to be able to capitalize on whatever happens in the economy, whether the economy booms, whether the economy slows down, whether inflation goes up or whether inflation goes down. And this requires you to, number one, have cash savings to protect you against an emergency and pay off your credit card debts, but then also have cash to be able to capitalize on investments. That's called being financially prepared. Second, I want you to start investing in your financial education. That means learn how to invest, learn how to read stock charts, learn how to invest in real estate, learn how to underwrite real estate deals, learn how to find a good investment. And then number three, pay attention to financial trends. This means understanding where the shifts are happening in the economy and how things are changing in the economy. If you can understand these three things, you will be able to capitalize on whatever happens in the economy, because at the end of the day, a financially savvy investor does not get worried. They don't freak out. They don't panic. They just look for the opportunity. Because the reality is, we know the economy goes up and down, and I want you to understand how you can find the opportunities, whether you're going up or down. We just entered the next phase of the global economy. The Federal Reserve Bank is now cutting interest rates. Canada is cutting interest rates. China is now cutting rates, and countries across Europe are also cutting interest rates. And we've also seen some countries, on the other hand, now start to protect themselves against any sort of potential economic uncertainty by buying things like